Debt problems in the United States, which reached their peak in 2007, gave rise to a full-scale global crisis. Experts warn the situation may repeat itself as early as 2023. The housing credit market is stormy. Loans are getting more expensive and the ability to pay is peaking. But before we get started, subscribe to our channel, give us a like and post the video on social media. Next, we'll tell you whether we should wait for another mortgage crisis like 2008. According to the Federal Reserve Bank of New York, Americans' debts increased by $394 billion in December to a record $16.9 trillion, the biggest increase in 20 years. Borrowers have struggled to make loan payments amid high inflation and interest rates, Credit Union Times writes. Risks of mortgage defaults are again becoming a serious threat to the stability of developed countries. They could trigger a wave of defaults in the financial market, in terms of coverage comparable to the crisis of 2007-2009. According to the IMF report, how falling home prices could strain financial markets as interest rates rise. Against the backdrop of falling real estate prices, mortgage rates continue to rise, creating high pressure on borrowers. Among them, there are two particularly vulnerable groups. The first is borrowers with floating rate loans. The second are individuals who took out a mortgage in 2020-2021, when home prices skyrocketed amid the pandemic. At the end of 2022, the average mortgage rate was 6.8% for advanced economies, the IMF said. In 2020, it was around 3%, according to Freddie Mac. Experts of the organization point out that the highest risks of default in countries where there are high indebtedness of the population and a large number of loans with floating interest. At the same time, such criteria as the ratio of outstanding household debt to disposable income, real estate price dynamics, the dynamics of changes in credit rates and the number of households paying mortgages are taken into account. The countries most at risk of default include Canada, Australia, Luxembourg, Norway, Sweden, the Netherlands and the United States. Slovakia, Slovenia, Italy, Hungary, Greece, Latvia and Germany have the lowest risk of default due to a collapse of the real estate market. There are important differences between current conditions and the global financial crisis that happened a decade and a half ago. In most cases, a sharp fall in real estate prices could cloud the economic outlook for advanced economies, although it is unlikely to trigger a new financial crisis, the IMF experts report. They note that the ratio of debts and household incomes in developed countries is already comparable to the indicators of 2007. Mortgage issuance fell to $498 billion, the lowest level since 2019. This is an extremely worrying signal. Reduced demand is triggering a decline in real estate prices. Ordinary Americans may rightly wonder, why pay a mortgage for a home that was worth more when the loan was approved? It is easier to stop paying, let the bank take the property for non-payment and make a new loan on more favorable terms. Actually, this is what happened in 2007. Then millions of properties were abandoned. People simply left their keys in the keyholes. Banks could not realize the real estate at the previous value, which led them to problems. It could all happen again. The time of low interest rates is over. Mortgages are now serviced at 8%. For those who bought real estate at exorbitant prices, it becomes a burden. We are getting a strained mortgage situation and, as a result, the banks. This is a sign of an unhealthy U.S. economy. Going forward, a worsening U.S. economy could lead to an increase in bad loans. Reacting to this, banks in America have significantly tightened credit conditions in recent months. The problem could be solved by refusing to raise the key rate, on which mortgage rates depend. However, the Federal Reserve cannot do this yet. Its main task now is to keep inflation in check. The Fed, the American analog of our central bank, raised the rate to 4.75% in early February. Federal Reserve Chairman Jerome Powell said at a press conference that the regulator still has a lot of work to do, and that it is firmly committed to achieving its 2% inflation target. U.S. inflation is currently at 6%. In August, the average rate on a 30-year mortgage in the U.S. topped 7%, the last time such terms were offered to U.S. borrowers back in 2002. This has already rolled back the issuance of mortgages to the level of the end of 2020 if you look at the money. If you look at the number of applications, demand has collapsed to the level of almost 30 years ago. This situation has had a noticeable impact on construction. If in 2022 in the US issued 1.8 million permits for new construction per quarter, in 2023 only 1.4 million. There is a clear slowdown in both the banking and construction sectors. But paradoxically, it does not affect real estate prices yet. Case-Shiller U.S. Index. National Home Price Index, which reflects the value of U.S. real estate, is still near the peaks, which it quickly climbed on the background of COVID distribution of money. Moreover, by September, the cost of square footage had crept back up again, which is considered one of the factors that could prompt the Fed to raise rates again or at least keep them at current levels for longer. Of course, the U.S. real estate market is quite heterogeneous. On the West Coast, where housing prices have risen dramatically in recent years, followed by an increasing homelessness and crime problem, prices have already fallen 11% from their 2022 peaks. This includes Las Vegas, Los Angeles, San Francisco, and Seattle, for example. But this is not yet the case in the center of the country and on the East Coast. Housing in Chicago, Boston, New York, and Miami either continues to rise in price or is holding at its peak. There are several reasons for this paradox. First, it is obvious that the dollars printed by the Fed in huge quantities have not yet collapsed and continue to influence prices. Secondly, the U.S. labor market is still strong. It is supported, in particular, by industries moving to the U.S. from Europe. Recession in the country is still not coming, at least, statistics does not record it. Third, almost entirely dependent on mortgages, the American market itself insures itself against the fall. Those who would like to sell an old house, as a rule, when buying a new one, still have to take out a mortgage. This forces homeowners to abandon their plans, which naturally reduces the supply of housing on the market. The few buyers have to compete for the homes and condos put up for sale by individual daredevils, driving up prices. What about the U.S. mortgage-backed securities market that was the catalyst for the last real estate crisis? It has now changed and consists mostly of securities guaranteed by the government through the mortgage agencies Fannie Mae and Freddie Mac. The $8 trillion in MBS is packed mostly with loans taken out at still 3%. At the same time, these securities are gradually getting cheaper, and in early summer the U.S. financial media convinced investors that it was time to get into mortgage bonds and the funds that hold them. Say, this is the bottom and a good chance to get a return of around 5%. But it wasn't the bottom yet. Since then, shares of the largest fund investing in mortgage bonds, the iShares MBS ETF, have plunged another 3% and are now almost 10% cheaper than they were at the height of the 2008 crisis. The fact is that the two biggest investors in MBS, the Federal Reserve and U.S. banks, have gone from buyers to sellers over the past year. The Fed has been shrinking its balance sheet to keep inflation down, while lending institutions have been forced to sell off assets due to depositor outflows. It is impossible to do anything without increasing inflation. The U.S. financial authorities have already missed all chances of a healthy solution to the problem. The only mechanism left is catastrophe. The U.S. authorities can zero the rate and flood everything with money again, but in this case inflation is inevitable. In order not to let the villain of inflation run wild, the U.S. is going to extreme measures. On March 1st, the White House food stamps program is being cut. Payments to the elderly will be cut from $281 to $23. Support for other categories of the population is also being cut. Currently, 42 million Americans benefit from these support measures. But a repeat of the 2007-2009 housing crisis seems unlikely. Back then, this situation arose because of the proliferation of financial instruments tied to the mortgage market. There was no adequate supervisory system for both these instruments and their derivatives, which led to the bubble. Since then, strict measures have been taken against all financial structures to reserve capital in case of such situations. Also, the market for securitized securities, which were the source of the crisis, has practically disappeared. Guys, if you liked our video, but you haven't subscribed to us yet, subscribe right now and post the video on social networks. There will be a lot of interesting things in the next episodes. See you soon. Bye.